Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about the S&P 500's bear market that we're currently experiencing, and we're going to compare it to prior bear markets where we also experienced high inflation. We put out a very similar video last week where we talked about this bear market compared to all of the prior bear markets you can see on this chart. But in this video, I really want to focus in on a few prior bear markets that also had high inflation as sort of the running narrative. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Equityverse Telegram channel, which you can find a link to in the description below. Let's go ahead and jump in. So the first thing I want to do is just hide everything except for the current bear market, which of course is moving down stochastically, right? It's not monotonic. We go down, we put in a low, we then put in a high, then we put in a lower low, then a lower high, and so on and so forth. And this has been going on for basically the entire year. Now, it's only natural to want to compare or cherry pick certain bear markets to tell a story that we might want to tell. However, it might be more useful to start by saying, okay, we're currently experiencing high levels of inflation. When in the past did we also experience high levels of inflation, and what did those bear markets look like? Now, to get an insight into that, let's just go on over to something we talked about in the last video, and that is inflation year over year. And we're just simply going to go back and look at times when we had very, very high inflation. And the first, major, most recent points to bring up would, of course, be in, say, the early 70s and then also in the early 80s. Okay, the early 70s and the early 80s. So maybe like 73, 74. You can see there's a recession in here. You can also see there's a couple of recessions here in the early 80s. So that's what I want to start with. Okay, and we're going to see how this current bear market so far compares with these also high inflationary periods. So we currently have the 2022 bear market pulled up. I'm going to click on the 1973 to 1974 bear market. This is what that one looks like. Now, what's interesting about this is that it has played out in a somewhat similar manner, although if it's a bear market and it's just sort of going down, I think our eyes will always deceive us into making things look like they're the exact same thing, when in fact they're not necessarily. But what you'll notice with, say, the early 70s bear market, 73 to 74, is that we had a period of, lower lows and lower highs, followed by it getting relatively flat for a while, and then followed by another major pullback in the S&P 500. If this were to manifest itself in the current bear market, I believe the narrative that would accompany something like this would be inflation starting to come back down over the next 6 months, and therefore, the stock market not really doing anything that significant, but maybe getting somewhat boring. And then once it becomes clear that the Fed went too far in raising rates, I of course have said before, I think they have to raise rates to get inflation back down. But if they push us into a full-blown recession with unemployment spiking, and where we see, of course, a 3-month and 10-year invert, then you might see, a future leg down. This would be if it were to compare to the 1973 to 1974 bear market. So to put that in perspective, just so you can sort of try to figure out what that would mean, the 73 to 74 bear market lasted about 633 days. This one so far has lasted about almost 300 days, about 279 days. So another month or so, it'll be 300 days. Meaning if it were to last the same amount of time as the one back then we're about halfway through it. Okay, this would be if in fact the Fed pushes us into a full-blown recession and we eventually see that second leg down. Now, another way to look at this too is to then say, well, what happens 3 months out of that? Because it's always easy to look at the downtrend and to think like, okay, it has to go down, or, we might easily think that. But if you go, say, 3 months out from the bottom, you can see how we bottom. We kind of bounce up for a little while. We put in a lower high, and it's relatively quiet for a while, right? Like no one really knows is the bottom in or not. And then if you take it to, say, the next peak, it really puts things into perspective, right? Like it really does. And that's why when you find yourself in a period like this, where if the stock market is losing ground relatively quickly, panic selling into a capitulation candle generally does not work out that well, because when the S&P 500 recovers, and if history is any indication, it usually does, then it could quickly leave those prices behind. And so this sort of puts it into perspective. Yes, you can have bear markets. Sometimes they can last a couple of years, but you then generally get a fairly nice bull market that comes out of it. Now, I want to compare it to a different one. We just looked at the one that came out of the 73 to 74 bear market. Now let's look at the one in the early 80s. Okay, so that one's going to look a little bit different. And first, what I'm going to do is I'm just going to go ahead and pull it up with all three. This is the one from the early 80s. You can see the one in the early 80s that also experienced high inflation. This was when Volcker was in control and he was raising interest rates and creating two recessions to get inflation under control. You can see what happened, right? It was just a series of lower highs and lower lows. But interestingly enough, we didn't really have a major capitulation on our hands. I'm going to go ahead and hide the 73 to 74 bear market. We never really had that major capitulation that a lot of people probably were calling for back then, right? It just never happened. I mean, we did put in lower lows, okay? Like we were in fact able to put in lower lows, but did we see a 73 to 74 style capitulation at the end where it just goes straight down for 3 or 4 months straight? We didn't really see that, right? It just sort of slowly bounced around for a while. So while it can be easy to cherry pick certain bear markets and say, well, it has to play out a certain way, you can find other bear markets that don't look quite as bad. And what's interesting is if you were to then take the 80 to 82 bear market out to its peak, look at that, right? Like look at what ended up happening. So yes, if you go by this bear market and you just want to sort of look at it, what we're looking at right now, if you look at the 1980 bear market, it could mean that once again, the stock market might only be about halfway through its bear market. But it could just be one of those things where it's really long and drawn out rather than a major capitulation. These are important scenarios. And the reason I say this is because I'm not trying to say, the exact way this bear market has to play out, because the truth is no one really knows. The reason why it's worthwhile to compare to various bear markets is so that you can understand that what you think might have to happen might not actually happen the way you think. Okay? It could play out a completely different way. Perhaps we just have to go slowly down for a long time. Maybe we do get a final capitulation. But these are all very similar scenarios where you have high inflation, but they played out in very different ways. And of course, the Fed's response will of course have a lot to do with that. But I did think this was somewhat useful to look at multiple bear markets with, say, high inflation. Now, I think it would also be useful to go back to the 40s and show, there was a lot of inflation. I mean, of course, we had World War II, but we also had a couple of recessions, right, following these periods of high inflation. So yes, look at this bear market. It absolutely sucked. And if we follow that, it means we're only halfway through. If you pull up the 73 to 74 bear market, it could also suck for a while. But then look what came out of it. I mean, again, when you overlay the 1980s bull, or the bull run that came after what happened in 1980, look at that phase of economic expansion compared to what happened after the 70s. Why is that? Why was this one in the 70s tempered compared to the one in the 80s? You know why, right? Like you should know why. If you've watched this channel this year, you know why. And this is why I keep saying over and over and over again, I want the Fed to raise rates, right? Like I want them to stifle demand. Why? Because inflation, if inflation here, right? Like this is the 70s bear market. We came back out, right? We came back up, but the problem is that we just went into another period of high inflation, right? Because the Fed couldn't figure out what they wanted to do. Just kind of pivoting back and forth, thinking they had inflation under control, but it wasn't. So believe me, I mean, I do think the reason I'm very much pro raising interest rates and even going through the period of QT, quantitative tightening, is because I want to get back to a phase of economic expansion where we get 10 years of sort of a secular bull market, not a lackluster bull market followed by another recession, which is what happened in the 70s. So if you compare this bear market to the 70s, it's still, if you sort of came into the market after the capitulation, you still would have seen fairly decent returns. Okay, but it still would have led into another bear market, and then it took after that bear market to really see that major explosion in the stock market, as we got out of the inflationary times from the 70s and the early 80s. Now, to go back and compare it to the one that came after the Second World War, this is what it looks like. And first, we're just going to look at it compared to going into the bottom. So what's interesting about this is that you can see it also somewhat is following what happened back then during the 1940s, 1946 to 1949. Sort of we kind of came up for a little bit. We had our first sort of major correction down. We bounced back up. We came back down. And if something like this were to play out, then it would mean that the bear market, it might last for a couple more years, but we might just be sort of scraping around the bottom for a while. Rather than putting in, significant lows, significant new lows, we could be putting in slightly lower lows, whereas we just sort of scrape around for a while at the bottom. And if you compare this out to its next peak, look what happened, right? This lasted almost 4,000 days from once that bear market started, before the next bear market started. So this is what I'm saying. A lot of people have been fairly. I've seen the comments, right? I know a lot of people don't like it when I've been relatively bearish this year, and some people I think are upset, and maybe they feel betrayed because I used to be very, very bullish on crypto and whatnot, and I had to pivot that stance early this year. But look what happens after we get through the bear markets. Usually it's another phase of economic expansion, and I want us to get to that. But we have to be honest with ourselves that these bear markets can take time to play out. They don't resolve themselves overnight, right? They don't resolve themselves overnight. And I'll tell you something else. They don't resolve themselves when everyone still has the curiosity to tune into every single FOMC meeting. I cannot help but think that the bottom is still going to remain somewhat elusive until people lose interest. There still is some sort of pent up interest that that everyone cares so much about what one person has to say. I'm guessing the bottom is going to occur on, say, like a random Tuesday in 2023 or something. Then while everyone's looking at the most recent inflation data, there's a chance that happens. And one of the ways that plays out, of course, is if the Fed pushes us far enough into a recession where unemployment is actually going up, that you could see lower lows in the stock market if earnings start to come back in a lot lower than what a lot of people might expect they could. But if you look at, say, this bear market from the 1940s, and then we pull up the one from the 70s, and then we pull up the one from the 80s, and then compare it to this, where we currently are, in all three scenarios, the bear market still had longer to go. In one out of three of those scenarios, we had much lower to go. Much lower, okay? In the other two scenarios, right, like if we get rid of the one from the early 70s, in these two scenarios, we had a lot longer to go in the bear market, but we didn't go that much slower, right? We did go lower, okay? And you can see that if we sort of bounced around, it could easily take the S&P down to 3,400 or maybe even 3,200 if we were to follow these other types of bear markets. But it doesn't necessarily mean you have to see that final capitulation. If we follow something like the 70s, then you would see that final capitulation. The last one that I want to compare to is the financial crisis, because inflation did get somewhat high. 5% or so. It wasn't nearly as big of a deal back then. There's some nuances around it. But there are some similar financial conditions, not exactly the same thing, but we're seeing, we just saw a pretty major financial crisis occur over in Europe, and the Bank of England stepping in and restarting quantitative easing, despite the fact that inflation's coming in at like 10% year over year. There are some similar elements to it, right? There are some. I'm not saying it's identical because I know it's not, but there are some similar elements to it that you could argue that, look, things are starting to break a little bit. In the United States, I think there's some cracks. I don't really think anything's that broken just yet, but there are some cracks forming. And why not compare it to that bear market as well? And I'll sort of finalize it with this one. If you go back and look at the financial crisis and compare it to the current bear market, you can see what it currently looks like. And of course, it also looks similar. Isn't it interesting how literally every single bear market we look at, they can always look similar for a certain period of time, right? So like this is compared to the financial crisis, we look at it. Oh yeah, like it looks like it's the same thing. Then you compare it to the one from 46 to 49. Oh, it also looks very similar. Then you compare it to the one from 73 to 74. Yeah, you can see some similarities. And then the one from 80 to 82, which maybe isn't as similar. But what you'll notice is that our minds like to tell us, okay, something's going to play out the exact same way. But you can actually find plenty of bear markets that might line up for the first year, but then deviate in the second year. If we were to follow the financial crisis, then it would mean getting some type of a bounce for a month or so, followed by a major capitulation, at the end of this year or sometime in early 2023, and maybe it finalizing itself sometime in mid to late 2023 before all is said and done. And once again, if you compare this bear market to the current one, this is what you get. And if you compare it out to the peak, that's what happens, right? That's what ended up happening. So I've said this many times. I mean, I've said it on the on the premium side a lot more probably. But look, guys, I don't know exactly, I certainly don't know exactly what's going to occur. I don't know exactly how this bear market is going to resolve itself in stocks. Okay, I mean, there's the crypto bear market as well. I'm not sure exactly how this is going to resolve itself. But one of the things you'll notice in that all of these bear markets, right, all of these bear markets that we experienced, they did last about a year longer than where we currently are for the most part. When we had periods of high inflation and we were also dealing with somewhat similar circumstances. But look at the bull markets that were born out of them. That's the important part to think about. And this is where I think a lot of investors sort of get lost, is because a lot of investors only really care about it when the market's going up. But the gains, right? The big gains that you find are when you stick around, no matter how bad it gets. So I implore you, no matter how bad it gets, try to stick around, okay? No matter how long it takes, try to stick around. And eventually we will come out of it. And I hope to see us go through another period of economic expansion. If I'm being completely honest with you, I think that the stock market will continue to struggle throughout the rest of this year and a good part, if not all of 2023. I'm not saying it has to put in new lows in all of 2023, but I do think that there's going to be a lot of struggles that we're going to have to overcome with inflation staying somewhat sticky and continuing to see some supply chain issues. But by the time we get out to 2024 and 2025, I think a lot of these things I hope a lot of these things are behind us. I hope the Fed remains hawkish long enough so that we can really see inflation start to come back down, where they sort of kill demand for a little while. We get those cheap asset prices, or we just have to experience current low prices for a longer period of time. And then we can come out of that into another period of economic expansion. I'm not in the camp that it's going to take, like another 20 years or something for us to, see another bull market. I know there are some people that think that. Of course, I don't know if you guys are aware, but there is a school of thought that, that some people sort of think we're in a much longer bear market that is different. I'm not sitting in that camp. I do think though that this bear market, as I've said all year, I think it's had legs the entire year, and we will likely still see, some pain for some time to come. But I will remind you, right, in all of these scenarios, if we go back and you compare it out to the next peak, right, the bear market looks kind of silly, right? It looks kind of silly, but the second year of the bear market is where things got real, and it took a lot of strength, I think, to stay somewhat interested in the markets. So I don't know exactly which way the bear market will break next year, whether it's sideways chop like the early 80s and like 1946 to 1949, or if it's a capitulation like 1973 to 1974 or the financial crisis from 2007 to 2009. If inflation does not come down and the Fed keeps raising interest rates and we start to see unemployment spike, I think it makes sense to be completely ready for a capitulation, okay? If inflation surprises us and starts coming down quickly without unemployment going up, then you should be prepared for maybe continued lows, but not necessarily, a major capitulation down. I've expressed where I think we are. I am prepared for another drawdown in the stock market. But I could also, if we don't get it and inflation comes down and unemployment never starts to go back up, then I would probably, I might change my mind at some point in 2023. But I think right now it makes sense to sort of go into the end of this year and go into 2023 with a general expectation that things will be relatively choppy and could easily have a bearish bias for, for at least another 6 to 12 months, okay? For in the stock market. Easily could have a bearish bias or a sideways at best type thing for another 6 to 12 months. And then by the time we get out to 2024, I think there's a good chance inflation will start to really come back down. I don't think the Fed's going to keep raising rates that long. They'll probably at least stop raising rates at some point in 2023, and then I hope that we can see another phase of economic expansion. But do not, I would say this. I mean, I'm not offering financial advice, but do not miss out on another phase of economic expansion because you're not willing to stomach the next 6 to 12 months of whatever this market brings. Okay? I would say no matter what this market brings over the next 6 to 12 months, just try to look past it, right? Like try to look past it and what normally is born out of that. And I think that is where a lot of the real money is made. I've said many times before, in the cryptoverse, we're in the equityverse right now. I'll say it again, right? Bull markets make you money, bear markets make you rich. If you stick around over here and you have the patience to really come into the market with strength, I do think a lot of 2023 will present a lot of great opportunities. That's where all the real money is made, right? When you keep staying in the market, even in the depths of the bear, and you prepare yourself for the next period of economic expansion. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up. Remember to check out Into the Cryptoverse Premium at intothecryptoverse.com. You'll get access to this website as well as a whole lot of other stuff. So make sure you check it out in the description below. And I will see you guys next time. Bye.